Dear Heavenly Father, thank you for the day, thank you for the blessings you have given us and the opportunities we have to learn. Please bless us with wisdom and understand us as we learn about your plan for our life today. In Jesus' name, Amen. Speaking Father.
Good morning. Good morning, everyone. I'm Feasibility and I am the first reporter of this group. So our topic is all about developing projected financial statements. Content. Introduction, projected balance sheet, projected pro-forma income statement, forecasting cash flow. Objectives. To understand the significance of projected financial statement in guiding the organization's financial planning. To understand the importance of the projected balance sheet and its role in managing assets, liabilities, equity, and etc. To know the importance and purpose of cash flow forecasting. Introduction. A projected financial statement is a financial statement prepared based on a show of events and transactions that have not yet occurred. It is crucial in financial planning and analysis, helping to predict an entity's financial future. Projected financial statement identify opportunities and potential obstacles and provide a platform for evaluating alternatives for committing capital. So what is projected financial statement? A projected financial statement are documents that show the expected financial performance of a business or a project in the future. Example of these are balance sheet, income statement, and cash flow statement. What is projected balance sheet? Projected balance sheet are statements that show estimated changes to a company's financial status, including assets, liabilities, and financial core equity. A balance sheet consists of assets, liability, and capital of equity. So the table below is an example of balance sheet. Balance sheet of any town cooperative hardware store fiscal year ended December 31, 2009. So there are the three types of balance sheet. Assets. There are two types of assets. Capital current assets and non-current or fixed assets. When we say current assets, these are the short-term example of these are cash and deposits, account receivable, inventory, and prepaid expenses. And the next one is fixed assets. These are the long-term kind of assets. Example of these are investment, land, building. There are also two types of liabilities. The current liabilities and the long-term debt liability. So current liabilities, for example, is the account payable and taxes payable. And also the long-term debt, which is the long-term, the example of this is mortgage. And also in the capital or equity, which is the owner's capital.
Good morning, everyone. I am Michael Gajana, second reporter for this morning. So my part is connected to Ms. Francisco's report. I will discuss or give definition about current assets, fixed assets, current liabilities, long-term liabilities, members, equity, and retained earnings. First, let us define current assets. Current assets is an asset on the balance sheet which is accepted to be sold or otherwise used up in the near future, usually within 1 year or more business cycle. And current assets is the resources that a business owns and expects to use or sell within a year. Why current asset is important? Current asset is important to a business because they converting them to cash. They allow it to pay its day-to-day operating expenses. Bills and loan payments is current liabilities. Next is fixed assets. Fixed assets is comprised of property, land, and equipment. Or example is buildings, land, and machinery. Or property which cannot easily be converted into cash. In most cases, only tangible assets are referred to as fixed. These are items of value which the cooperative has bought and will use for an extended period of time. So, example is vehicles. Next is two types of liabilities. First, current liabilities. Current liabilities are considered liabilities of the business that are to be settled in cash within a fiscal year. Fiscal year, it consists 12 months or 1 year. Or the operating cycle, whichever period is longer. For example, accounts payable for goods, services, or supplies that were purchased for use in operation of business and are payable within a normal period or time would be current liabilities. Then next is long-term liabilities. Long-term liabilities are types of debt or obligations that are due to be settled over a time period longer than 1 year, typically in more than one business cycle. Example is bonds, mortgage, and loans that are payable over a term exceeding 1 year. Next is two types of equity. First, members' equity. Members' equity is the capital invested in the organization by cooperative members. In simple terms, member equity represents the financial contribution made by the members as well as their retained earnings in the organization. Lastly, or the last is retained earnings. Retained earnings is the portion of net income which is retained by the corporation rather than distributed to its owner as dividends. And retained earnings is it represents a measure of profitability and financial stability as it reflects the organization's ability to generate profits and manage expenses.
Good morning, everyone. I am Joy Religious Matagara, the third reporter in this video. So, what is projected pro forma income statement? A projected pro forma income statement is a financial statement that estimates the future income, expenses, asset, and liability of a business. It provides a forecast of the expected financial performance over the specific term, or typically a year. This projection is based on the assumption and projection about sales, revenue, cost of goods sold, losses, operating expenses, taxes, and other financial factors. Sales revenue is the total amount of money that the business expects to generate from the sales of goods or services. Cost of goods sold. These include the direct costs associated with the producing and delivering the goods or service. It includes the expenses like raw material, labor, and production overhead. Losses. This represents any anticipated losses that the business may incur, such as unexpected expenses. Next, which is what is the formula to calculate the income and the expenses? So the formula, which is revenue subtract expenses is equal net profit before taxes. This formula subtracts all the expenses from the revenue to determine the profit generated from the business before the tax are deducted. So the information needed to complete the pro forma income statement
following. Number 1, the projected sales volume for a year. This represents to estimate amount of sales the business expects to generate during the specific period. Number 2, the expected expenses of producing or purchasing the product or services, cost of goods sold. This is the expected expenses. Number 3, the amount of fixed operating expenses such as insurance, utilities, rent, interest costs, and other items for the year. So fixed operating is the main constant regarding the sales volume. So number 4, the variable operating expenses such as wages and benefits, advertising, and transportation. Number 5, the anticipated net operating profit or loss. The represent the expected profit or loss generated by the business after deducting all operating expenses from the revenue. The next is net sales. Net sales are the amount of those sales reduced by the customer return rate out allowance. So, customer discount are the reduction in the selling price of goods or services offered to customer generate as an incentive to encourage sales. Return. This refers to the amount of sales that are returned by the customer for a reason, such as dissatisfaction with the product or their changes. The third is breakout. This is the cost of shipping or delivering goods to customers. Some of the business may charge customers for this service and deducted from the gross sales to determine the net sales. Allowance. Allowance are deduction made for a various reason, such as compensation for issue experienced by customers.
Good morning once again. I am Alan Gonzalez. And since Jollibee already discussed the net sales, so let's move on to cost of goods sold. So cost of goods sold is defined as direct expenses incurred in the production of goods or services sold by the business. So this includes the materials incurred in creating the goods, together with the direct labor costs used to produce them. So how do we calculate the cost of goods sold? So the cost of goods sold, or COGS, is calculated by taking the value of inventory at the beginning of the period being studied, adding the cost of any new inventory purchased over the covered period, and subtracting the value of inventory held at the end of the period. So we have the three components of total cost. First is the cost of goods sold. Second is the selling cost. Third is the overhead cost. So since this is already discussed by Group 4 and this is already explained by Ma'am Yaya, I will not further explain this. But then let me just freshen up your minds. The cost of goods sold, as I said a while ago, this is the direct expenses incurred in the production of their goods or services. And then the selling cost, this includes the indirect expenses such as distribution costs and sales force costs. And then the third is overhead cost. cost, this includes the storage expenses such as utilities, salaries, taxes, and any other items. Next is gross profit. It is one of the most important measures of business. So the larger the gross profit margin, the greater the cushion of covering all business expenses while being able to provide the sufficient return to the cooperative. So this is the sample pro forma income statement of any town pharmacy. So they have net sales of $792,500, less cost of goods sold from the beginning of inventory. They have $125,000, plus the net purchases of $310,000, and then from there in the inventory, they subtract it, and they have the result of 230,000 cost of goods sold. And then gross margin, they have 562,500 minus the operating expenses. They have 569,925. That is equal to $7,425 from net profit loss before income tax. That's all.
Okay, good morning everyone. I am Ira Gaetana, the last reporter. So, my topic is about the forecasting cash flow. So, what is the forecasting cash flow? So, it is the first step in projected financial statement preparation to prepare a projected cash flow. So, the projected cash flow, it traces the flow of funds. So, meaning, it assesses the financial feasibility of the business. How will it be able to control as day-to-day financial affairs? So this cash flow traces the flow of funds. So and into and out of your business for the year. So when the cash it is used to assess the timing, amount, and predictability of future cash flows, and is used the basis for budgeting. So you can use also the statement to answer the question. So, it answers the questions, where did the money came from and where did it go? So, the cash flow statement measures only the cash inflow and outflow of the business. Non-cash and accounting interest shows up the income statement as depreciation, amortization, and acquisition or disposal of assets are not included in the cash flow. So, the cash flow only included for the cash, not non-cash accounting entries. Okay, so there are three sections to the cash flow statements. First is the operating activities, second, investment activities, and financing activities. So for the operating activities, these are the activities that are day-to-day activities that generate revenue and incur expenses for a business. These activities primarily involve the production, sale, and delivery of goods or services. Operating activities are an essential part of the company's cash flow as they directly impact its operating cash inflows and outflows. So these are the examples of operating activities in cash flows includes the sales of goods or services. So this is the primary source of operating cash inflows when a company sells its goods or services. It receives payment from customers, increasing its cash positions. Next is the payments to suppliers. It is a part of their operating activities. Businesses need to purchase inventory, raw materials, or services from suppliers. For the payment wages and salaries, employees are a vital component of any businesses. And the next one is the investing activities. In cash flow refer to the acquisition and disposal of long-term assets or investment by a company. So these activities typically involve the purchase or sale of property, plant and equipment, investment in marketable securities, and loans made to other entities. And for the financing activities in cash flow, it refers to the transactions that involve the raising or repayment of funds through the issuance or retirement of a company's long-term liabilities or equity. So these activities primarily include activities related to borrowing, repaying loans, issuing or repurchasing shares, and paying dividends. So these are some of the examples of financing activities. Issuance of debt. So when a company borrows money by issuing bonds or obtaining loans, it results in cash inflow. For example, so if the construction company issues bonds worth $1 million to finance a new project, it will record the financing cash inflow to $1 million. So, and next example is the repayment of debt. So when a company pays back its loans or reduces the outstanding principal amount, it results in cash inflows. For instance, if a retail business repays $500,000 of its outstanding bank loan, it will record a financing cash outflow of $500,000. And for the issuance of equity, when a company raises capital by issuing new shares of stock, it generates cash inflows from investors. So for example, if a technology startup issues 10,000 shares at $20 per share, it will record a financing cash inflow of $200,000. So these are the following, some formula of operating activities. So first one is the total cash receipts from the operations plus total cash payments from operation is equal to the total net provided by operations. So meaning those who are total cash receipts from operations, those were the cash received from customers, other operating receipts. From total cash payments from operations, those were the cash paid to suppliers, cash paid to employees, interest paid, taxes paid, and other cash payments. So those, if you add the total cash receipts from operations to total cash payments from operations, you will get the total net provided by operations. So the next one, the next formula is the formula of investment activities. So for the investment activities, the cash proceeds from the sale of assets, sale of investment in equity securities of other entities or debt securities other than cash equivalents, collection, it adds with the collection of principal on loans made to other entities, plus loan to other entities, plus the purchase equity of securities of other entities or debt securities other than cash equivalents. So is equal to the total net cash investment. Okay, next. The next one is for the total cash received from financing plus the total cash payments for financing is equal to the total net provided by financing. So in this part, for the total cash received from financing, those were the cash received from a financial institutions, proceeds of issuing stock, capital contribution by owners, plus the from the total cash payments for financing, those were the repayment of principal on loans, the dividends paid to the shareholders, cash withdrawals by owners is equal to the total net provided by financing. So for the conclusions of our report, in summary, the projected balance sheet, projected PROFORMA income statement, and forecasting cash flow are important elements of financial planning and analysis. So they assess businesses in making informed decisions, planning for the future, allocating resources effectively, attracting investors, evaluating performance, and communicating with stakeholders. So that's all, guys. Thank you so much. Do you have any questions? Thank you so much for listening. Thank you.
Putlo na. Diri na putlo. Putlo na. Putlo na. Okay na?